Okay, welcome back to another episode of the Corporate Real Estate Insider Podcast. This is episode 47. Lots to talk about today. John, in particular, has tons he wants to cover. First, starting with the recent announcement from the New York Federal Reserve. John, take it away.
I do have tons to talk about. I spend my weekends looking into news that might be interesting to share with the team. So I've got a couple. I saw this article from CoStar News, October 25th. It's about the New York Federal Reserve Bank. Titled Bank Strategy of Extending Commercial Loans Found to Escalate Financial Risk. And they say the unwillingness of some U.S. banks to fully assess their loan exposure to commercial real estate is increasing the risk of financial fragility in the economy. Again, that's the New York Federal Reserve Bank. Their analysis was titled Extend and Pretend in the U.S. CRE Market. Okay, so I'll skip through much of it. But then there's this gal, Rebel Cole, I think it's a gal, professor of finance in the College of Business at Florida Atlantic University. They have done some additional research on this. She says that it's understated because they just are looking at if the NOI is reduced since the loan was originally issued, and they're not looking at declining property values, which is leading to larger loan to value ratios. But what I found most interesting, they went on this Florida Atlantic University, and they calculate a bank's total commercial real estate exposure as a percentage of its total equity. Super interesting. So they did it for 4,594 banks. They said banks of any size, including smaller banks. And they have all these results. Essentially, bank regulators view any ratio over 300% as excess exposure to commercial real estate, which puts the bank at greater risk of failure, according to the university's analysis led by Cole. So that's 300% of total commercial real estate exposure, with the denominator being their total equity. So they got 1,849 banks, 40% of that total research that had exposure greater than 300%. Over 1,000 had greater than 400%. Over 500 had greater than 500%. 293 had greater than 600%. Like 600%, meaning 6x your equity is in commercial real estate exposure. So with the last bit on this, had to have some fun and Google our friends at Bank of the Ozarks. I'm wondering what their ratio is. Comes in at 584%. Well, this is actually now 6 months old, 7 months old. Found an article produced in LinkedIn by this group, Level Fields. There's some sort of a fintech app that does investment research. And they found Bank of the Ozarks 584% with $28.6 billion in CRA exposure over a $4.9 billion total equity base.
I've been following, as all of us have, this this closely for a number of years, right? So I read something recently that over 90% of assets in this cycle will have to kind of basically rewrite their loan to values and either retrade the debt and renegotiate it, or add more equity into the building to rebalance the building's debt to equity position. So a massive amount of capital either being written off, being retraded, being disposed of in some way to be able to rebalance these portfolios for these banks. And this is a good example of that. And I think some of it's been continuing to get pushed off and allowing the current operators and equity owners to continue to operate and extend the maturities. And some of them are being dealt with today, and I think that'll continue to happen. I think given where the Fed is with interest rates, although in the short term it really hasn't improved in terms of rates, but the expectation is that is a short-term change, not long-term. And the longer you can hold on and the longer you can wait, and if your banks are working with you, might as well continue to push it off and see if you can, negotiate into more favorable terms in 2025, 2026. So it'll be interesting.
Yeah, but there's so many mixed articles. I can't imagine lay people reading the newspaper about what's happening in the commercial real estate space. Have we hit bottom? Is it starting to show strength? Are we seeing investing activity picking up? There are a lot of articles out there that make it sound like we've gone through the worst of it. And then you realize that we really haven't dealt with these commercial real estate loans. It just feels like there's something festering beneath the surface that we really haven't dealt with yet.
Something I think we should talk about before we move on from this conversation around the Federal Reserve is just how wonky interest rates have been. I mean, if you go back to the Federal Reserve announcement on September 18th, right? So we're recording basically more or less 40 days ago, right? This is when the Federal Reserve came out and announced that they were going to not only reduce interest rates, but instead of doing it by 25 basis points, they were going to do it by 50 basis points. And if you look at the 10-year Treasury year yields on September 17th, we were at basically like 3.69, 3.7%, like right in that range. And today, as of recording, we're closer to 4.3%. So at 4.28%. So we're literally like 60 basis points above. So here the Federal Reserve comes out and says, hey, we're reducing the overnight borrowing rate by 50 basis points. And the market responds by taking the 10-year Treasury rate up by 60 basis points in 40 days. Like it's very weird. And I think a lot of people are trying to understand why is this happening? And when you think about, okay, why is this actually happening? Money is running out of bonds. In order to sell those bonds, they're having to offer higher returns in order to bring demand up to meet the supply of bonds that needs to be issued. But beyond the mechanical side of this, like why is this happening? And I have my own reasons that I'm fairly confident in, but I'm curious what you all think. And then I'm also curious what you all think will happen in the medium term. Like, is there going to be a convergence between what the Fed is attempting to lower rates versus how the market actually responds day to day?
Well, you mentioned getting wonky. I'll get wonky. I've mentioned it on here before from my econ degree. P dot E. P is the price level. P dot is the change in the price level. And the E is people's expectations. So we're talking, I believe, about people's expectations of future inflation. It's baked into the 10-year numbers. Somewhere in there, people are expecting that things are going to have to bump up. And, it becomes a self-fulfilling prophecy, by the way.
Yeah, I generally think that there's massive amounts of risk in the market right now. I think things with the election, with economic uncertainty around growth in the economy, we having a soft landing or not, with the massive amounts of debt being added to the U.S. balance sheet over a number of years, multiple presidencies, kind of forever. There is the expectation that the markets have become much more frothy, more risky, and we're seeing that in these yields, right? So your point is well taken. I think it's going to take a lot of growth, a lot of stability with some key benchmarks, and with I think the U.S. election to calm all the markets down with respect to yields becoming more in line with historic trends on where they should be as the Fed drops rates.
Yeah, in many ways, I think that the 10-year Treasury being higher is actually very bullish overall for the economy. I think what you are seeing happen is money is flowing out of bonds because there's an expectation that these other asset classes are going to be performing well. So, generally that money coming out of bonds, right, is not just going and, necessarily sitting on the sidelines and cash. It's very likely moving into the equity markets, right? And that's in anticipation of there being higher returns for risk on assets like equities and other higher risk assets than the risk-free rate of buying treasuries. So I think it's a bit bullish, but it also does shed some light on the fact that the Federal Reserve, despite all of the power that they do have, the market is going to react accordingly. So clearly the market thinks that a 50 basis point reduction was too much. And you look at the, only other times that there's been a 50 basis point reduction was in the financial crisis and in the, tech wreck in, 2000, right? There have not been many instances where the Federal Reserve has cut rates so dramatically. So I think most of the market is looking at it and saying, okay, historically, when there's been a 50 basis point cut, it's because we've been in a very dire situation and it was warranted. And in this instance, maybe a 25 basis point cut would have been more appropriate. Hey, the economy is doing well. we've stemmed inflation. We think it's time to start bringing down rates. We're going to bring it down 25 basis points. We're going to see what happens. We're going to look at another month or two of economic data, and then we'll be back. But yeah, I think there's a lot of extra political pressure in election years, and I think it's very hard to know exactly what to do. But I mean, clearly the bond market is an enormous market, just humongous compared to the total size of the equity markets. And clearly the bond market didn't like that there was a 50 basis point cut, unless there's other factors that are being priced in. I mean, obviously over the last 30 days, there have been a lot of changes in terms of polling and betting markets on who is likely to win the presidential election. I think that is also priced in here, and that may have not been priced in 30 days ago. So yeah, lots of interesting things going on here. And obviously the 10-year Treasury is probably the most impactful public market comp available for the pricing of real estate assets on a wide scale. Obviously there's variance market to market, but it's a really big figure, and it's not moving in the direction that property owners had hoped.
I think I agree with a lot of what you said. Couple things though. One, last I looked, the consensus was about $2 trillion in capital sitting on the sidelines right now waiting to be deployed. So massive amounts of undeployed capital waiting, which to me signals people don't know, people can't clearly underwrite the risk in the market, so they're waiting. Secondly, your point on interest rates and the risk-adjusted return versus why are interest rates doing what they're doing? And I'd have to tell you the market is performing around that 50 basis points cut. The market is performing like, you're right, it was too big of a cut, but they're also looking at it saying, what don't we know, right? What does the Fed know that we don't? And why are they taking a sledgehammer when you could use a hammer? It's creating this level of uncertainty of like, where are the banks? John, you talked about the Bank of Ozarks. How are the banks doing? What's their stress test levels? What are we looking at? Are there assets that haven't been marked to market? What is commercial real estate bigger than what they're leading on? Is the markets in general priced appropriately for the level of risk that's out there? And there's just creating uncertainty when they make a move like they did, when the consensus likely was that it was going to be a 25 basis points cut. So I think from our perspective, it's good that they did it for the commercial real estate sector, but at the same time, the markets aren't performing the way to be able to capitalize on the reduction in the benchmark.
I think a lot of this has to do with the pending election, and I think that people aren't giving that enough credit in terms of what it's doing to treasuries and the yields. We have two different candidates, and whereas one might support more spending or tax cuts, which arguably could raise yields if the debt increases, you've got the flip side policy could be fiscal discipline or higher taxes that might then possibly lower yields due to higher demand for treasuries. So I think there's a lot of uncertainty as to who might be leading our country in early January. If we have a new administration with fiscal policy that could shape the Fed Reserve's inflation and interest rate strategies, think about that. If the government spends more and causes inflation, which I don't think either candidate's going to do, but let's just say that happens, interest rates and yields go up. If the policies help, continue to control inflation, interest rates and yields go down. I don't think we do have two different candidates with different policies that they like to promote. And I think there's a lot of uncertainty as to who we might end up with as our president. And I think that's being baked into the volatility of the market right now.
Okay, I want to go back to something that Brian said around what's the Federal Reserve know that we don't know. I don't think the Federal Reserve knows anything that the general market consensus doesn't already know. I think the Federal Reserve has outdated data and that they are operating in the Stone Age compared to systematic quant trading firms that are the ones that are really pricing and driving where bond yields are. I think that if the Federal Reserve was completely reshaped to be to provide rate increases and rate cuts in a similar way to say like Citadel decides whether to make investments or not, that we would have a way more stable, way more easy to understand economy that does not have the same political bias. I think a lot of these decisions are just like, yeah, 50 basis points instead of 25. Yeah, okay, sounds good. Like, I think that it is significantly less sophisticated than how institutional investors are pricing risk, and that we would be way better off if the Federal Reserve changed how it did rate increases and decreases.
It wasn't long ago that we were talking about, and I gave the analogy of trying to control a steam, an ocean liner, and they're trying to maintain 3% growth, and they've got certain levers they can pull. And we were all worried about recession, and we needed a cut to stimulate. And now they've given us 50 basis points, and all of a sudden it's too much. And like, there's expectation that we're going to be going 3.5 kilometers per hour instead of 3. It's almost an impossible task to steer this ocean liner and maintain a 3% growth without a little bit of oscillation over correction. But I did find, here's an article that was produced published 2 hours ago. And by the way, long-term money is supposed to be a higher interest rate than short-term money. I mean, there's a time value of money, right? So we're finally getting away from the inverted yield curve where long-term money was priced below the shorter-term money. So here's an article titled, Treasury Yield Curve Uninversion Hits Milestone on Inflation Fears, Tsunami of Supply, QT, and now mortgage rates near 7%. It's everything we just said. It's all of those things. It's inflation fears, a tsunami of supply, and capital on the sidelines. I think we've assessed it correctly. And, could the Fed do better? Sure. I bet they're using some of those tools, but, it's an impossible task. They're trying to steer this ocean liner with the tools that they've got. I think they're doing an okay job. Let's see what happens next.
It's the worst job in the world because you can never make everyone happy. At the same time, the way that you make the worst job in the world no longer a bad job is to be completely transparent and formulaic around what's going to cause increases and decreases. And if you took the smartest people in finance and the smartest people in government and said, we're going to come up with a formula to help buoy the economy and have a transparent system for people to understand what's going to happen depending on what triggers come into play, that'd be so much better for the market. I mean, literally, if you are a macro investor, in many ways, if you look over the last 5 years, you have been sitting there thinking, okay, what is the Federal Reserve going to do? Like, that's literally what you spend the majority of your time trying to figure out. Like, how unproductive is that? Like, why not be figuring out what's actually going on in the economy? And instead, you're figuring out what's going on in the economy so you know what the Federal Reserve is going to be looking at when they decide whether to increase or decrease rates. Like, it's completely silly. And if the Federal Reserve doesn't want to be constantly criticized, then they need to take the subjectivity out of it or show exactly what their process is in a transparent way so people understand how these things are priced. But sadly, that's not going to happen.
So the difference between the Fed and the quants is that the quants can react. The Fed, almost as important as the moves they make, is the messaging about the moves they're going to make. The last thing they want to do is surprise the market. They surprised the market and it killed Silicon Valley Bank. Like, they can't do that. So they need to message and they need to be on message. So they're so careful about what they say and then delivering on that. They're trying to hit expectations every time. But I would argue that the messaging around what they're going to do is almost equally as important as what they ultimately do. One of their main roles is to not surprise the market.
Yeah, the dual mandate of the Fed, it also has an issue here. You can't look at purely as a comparison to one of these quant investment firms like Citadel, because you've got to look at it from the perspective of their mandate is maximum employment and stable prices, so inflation and jobs, right? So you can't, if you're looking at maximizing job growth, at times it goes against how you reduce inflation. So it's almost it's a no-win situation depending upon the underlying economy. And the other piece of it that people don't talk about is, I think the last time I looked, our debt to GDP was like 125%, right? We're spending, our debt is over $25 trillion, and we have to pay interest on that. And the Federal Reserve it has to look at that, and they're not going to come out and tell us that because it's not part of their mandate. But the cost of us being able to service the debt as a country is just exploded, and it's exploded under both left and right administration. So there's no right answer or wrong answer here. But the reality is it's exploded, and that has to weigh in the decision making here, and it becomes a no-win situation, and it isn't purely driven by their mandate, I would think.
Sounds like all the more reason to have a formulaic way of deciding whether rates go up or down. If the most important thing is not surprising the market, then bring more transparency to how you make these decisions and let the market iterate on what the best way to make those decisions are, instead of having a secret black box that every single investor is trying to predict what's going to happen in with no visibility into what's inside the box.
See, that's a great point, Tucker. I actually thought you were going to say it's a great reason to have this alternative asset class that's totally separate from the U.S. Fed and U.S. interest rates, and being able to protect money in a way that's not traditional through U.S. debt.
I like where your head's at, Brian.
Right. The more you think about it, the more that the markets don't perform in the way that they should, right? Dropping interest rates 50 basis points versus 25, or interest rates going up when you'd expect them to go down, to me, lends itself to say we need to decouple wealth from the market.
So let me bring this back to commercial real estate just as and wrap this segment. So if the extended pretend is about buying time so that we can rescue some of these loans in a future where loan rates are lower, apparently that's not happening. They extend the loan for how long? A year, 2 years? But now the 10-year Treasury's gone up. So the hope of actually being able to rescue that loan in the future at a lower rate may not be the saving grace that the extended pretend strategy was based on. Okay, let's pivot. I'm going to go upstream. I want to talk about VC. And so maybe this is too far upstream, but it's interesting. That's sort of like the source of growth in the economy, largely investing in new companies. Super interesting to track. Here's a article out of CoStar Analytics. After 3 consecutive quarters of improved venture capital activity, investors took a step backward during the third quarter of 2024. According to data released in the latest PitchBook NBCA Venture Monitor, U.S. venture capital investment in the third quarter witnessed $37 billion investment volume across 2,794 deals. That represents a 33% decline in funds and a 24% drop in deals executed from the previous quarter. I looked further, and the same trend is global. Global VC investment falls to the lowest level in nearly 7 years. This number of anyway, and what investment there is largely going to AI today. Anyway, it's dropped. It pulled back in Q3. What gives? And then I want to. They listed out the states capturing the most VC investment volume. Top 5, Massachusetts makes the list, but it's California, New York, Massachusetts, Texas, and Colorado. I was surprised to see the volumes. I was going to quiz you all and let you try and guess what you thought the volumes would be, but I'll just give it to you so we move through this quickly. California tops the list with $63 billion invested year to date. New York's number 2, $18 billion. Who do you think's number 3, Brian? You bet. Massachusetts, $11 billion invested year to date. Texas with $5 billion and Colorado with $3 billion. So I just think that's pretty interesting. It feels pretty good to see such a lion's share coming to California.
Yeah, we just to clarify, we go on mute when we're not speaking. So I was slow on the trigger there. I would assume Massachusetts is 3 because VC investment's way down. We're usually in the top 3, but at times we can catapult up the list if the life science industry is robust, and right now it's DOA.
I hear you.
So I think a lot of what I was listening to on this, because it is a topic we're talking about here a lot, given the lack of investment in the life science industry, is folks have a lot of deployed capital, and if you look in the markets, there's not a lot of companies going public. There's not a lot of acquisitions. So capital is deployed and you need to have capital free up before you can reinvest it, right? So, and the cycles for these companies are way longer right now, given the lack of exits, and that is impacting companies' ability to put that capital to work in new opportunities. So, I think when we start to see an uptick in exits through acquisitions or into the public markets, we're going to start to see reinvestment pick up. As the capital flows back into these coffers, and then they find new ways to deploy it. So I think it's a great metric to track, because it shows, it shows, especially in markets, in those top 3 or 4 markets, it'll show where, the growth of those early stage companies, and if it's going to increase.
I was on a tour last week in South San Francisco, a biotech client. We toured a project. Septerna is in the building. They went IPO last week. And in fact, the shares jumped 19% after opening. So there's some signs of life. I think there is 250 million. Anyway, signs of life.
Signs of life, and we've gotten away from where, during the pandemic, seemingly, and I'm being facetious here, but seemingly you could just put together a PowerPoint deck and go meet with a bunch of investors with an idea in life science and get money. It was flowing readily and freely, even to tech. And so I think, John, the slowdown, yes, there's definitely some extenuating circumstances that is causing this, but it's also just not as frenetic as it once was due to some companies that just didn't make it. I think people are being more judicious with their underwriting. And so it's perceivably harder to raise money. But then my question is it really harder, or are investors now being smarter than they were when during the pandemic? It was insane. I mean, money was flowing freely at 0%, and I think people have learned from mistakes. Let's change gears. I'll take it somewhere a different direction. There's been a lot of news. I don't know how many of you read commercial real estate news in periodicals, business journals. There's even an article in the New York Post, but the news is out of New York, and there's been a lot of talk about how office is back. There's just a tremendous amount of demand. That during the pandemic, in the worst of it, there was only like 3 million feet of demand at one point, and there's the articles all talk about this this insatiable demand for office space in New York, and I want to talk about 2 things. Number 1, the demand itself, and number 2, where it's going. So let's talk about the demand itself. The articles have talked about how right now the big brokerage firms, those that are publicly traded, are talking about tracking 26 million square feet of activity, up from half that just a few years ago, which I think is tremendous. That's great. But I think what the article failed to mention, and I'm not trying to suggest that the market isn't coming back, but all of that demand right now in New York, or I shouldn't say all of it, but most of it, I would suggest, is 2026 or possibly 2027 tenants, meaning their leases expire in those years, starting to come into the surge of pre-COVID 10-year lease expirations that were so abundant in cities across America, New York being no exception, from 2016 to 2020. So that 26 million feet of demand right now, and I'm going to speculate here, but probably represents 40 to 50 million square feet of tenants, and will have negative net absorption accordingly, meaning that when these tenants act on these expiration dates that are forthcoming, they're going to take less space. And yes, you do have companies across America coming back 5 days a week. Amazon is one of them that made headlines a few weeks ago. January, I think 2nd is when they're back 5 days a week. But I've read reports that in New York and other major metro markets across the country, only 10% of companies are back 5 days a week. So, yes, you do have some financial service firms that are back, but by and large, across the hundreds of millions of square feet of office space that make up New York City and elsewhere, only 10% are back 5 days a week, and 60% have permanent, what they claim are permanent hybrid schedules. And so I guess the question, and this is an open question, is this a ticking clock that the market is going to soon come to reckon with? I don't know if people understand or they're willing to accept what's coming their way, because there is still a tremendous amount of negative absorption, I think, that's going to hit the market. So I'm going to stop there, and then I want to talk about where the demand that is out there is going. So, John, it looks like you have a question, comment?
Well, I mentioned earlier how the news is so mixed, depending what you're reading and who you're believing. Either the market meltdown has yet to occur, or we bounced through and we're on the other side of it. And so I'm going to take the bullish side of that story briefly. Did you read about Tishman Speyer and Rockefeller Center? It was a week ago. They refinanced Rockefeller Center, $3.5 billion CMBS loan, taking out their 1.7 existing CMBS loan that was due to mature in May of 2025. Bank of America and Wells Fargo were co-lead managers on it. It's at a 6.2265% interest rate. And yeah, I looked up Rockefeller Center and CoStar. It looks like it's maybe 5% vacant and available. I mean, that sounds like signs of health.
I don't disagree, but this is a good segue into the second part of my discussion here, is that across America, across all cities, it happens to be a tale of two cities. So there are ultra-luxury Class A plus office towers that are in submarkets throughout the city that are sought after, and who are seeing massive pricing surges in some cases. In New York, it's being reported that some office space in the ultra-luxury buildings is going for upwards of approximately $300 a square foot, which is insane. We don't have anything close to that here on the West Coast. On average, just to put it in perspective, it's been reported that Manhattan has an average rent of roughly $77 a foot, but some of the buildings are only getting $40. So is the carnage over? I think for some, yes. Some of the premium assets, sure. But what I'm trying to, the point that John, I think is forthcoming across these markets is that the buildings that are not part of that ultra luxury or Class A are due for really dire circumstances forthcoming. And this is that commodity office space that is trading, at a fraction of what the premium space is trading at. And as people look to get people back to the office, no matter how much space they may take, if it's less than they had before, so be it, they're generally speaking going to gravitate towards a nicer product. Nobody wants to go back to that, in New York, that $40 rent building. I don't know how, that just seems depressing to me when you see other firms going to nicer products. So that's happening in New York. It's happening, I think, across America. Brian, you had some good comments and statistics about this in terms of where the overall availability stands in these asset classes.
Yeah, and this is specific with New York. The 72% of vacant space is in just 15% of buildings, right? So it lends itself exactly to what you were talking about. There's 40% of assets in New York have little or absolutely no vacancy. 40%. Right, and what's buildings are they? They're the newest ones, they're the nicest ones, they're the best located buildings. And in 2024, 55,000 housing units were created from former office buildings in New York City. 55,000. It's 4 times as many as in 2021. So the trend, and this is coming from a conversation I had with a friend in New York. The trend of conversions had started well before I think it became popular to think through this across the country, because everyone's talking about converting old office buildings. New York was going through the cycle sooner because the trend had started already earlier. People didn't want to be in some of these low quality buildings. There were some really, really tired buildings that got leased because there was a lack of quality, affordable space. But those buildings now, for many years, have been sitting vacant and have been pulled out of inventory and are in the conversion process. So it's showing that tenants are making decisions. Tenants are becoming confident with their occupancy. So another thing that I saw in this is that often as leases mature, firms are now giving back between 10 and 12% of their space. So they're downsizing, 10 to 12% versus numbers as high as 15% in 2021 and 2022. So not a huge difference, but material in as you think about a cost of a lease over many years. So there's a stabilization into what companies are giving back. Companies are getting to at least the end of a cycle of figuring out who they're going to be in terms of their office occupancy. And I'd tell you, if a company comes back 3 days a week, their occupancy needs on those 3 days are not much different than a company that comes back 5 days, unless they drastically change how they use the space, right? Because it's if you need to get everybody in the building on those same days, and most companies they're not having split schedules, those 3 days are 70-80% peak numbers, the same as they were before COVID and when those numbers were 4 to 5 days a week rather than 3 to 4. So I'm very bullish. The piece of this that I'd love to dig in on another pod is around new construction pipeline. So as you look at, companies are clearly favoring newer buildings, right? And I'll give you this in Boston. So there's 2 brand new buildings in Boston that one of them's under construction that's done a couple deals, and there's one that delivered. One of them's owned by Hines, and one is owned by Millennium, the residential developer with amazing amenities. And I just toured the building and Cambridge Associates space last week, and it's awesome. It's really, really, really well done. That's Millennium's project. And the rents and I'm not talking about Millennium's building here, but in the rents in Hines' buildings, they're doing effectively $100 gross deals with $200 in tenant improvements and for a 10-year lease. And if you take a top of the market, top of a building, older quality, 10 to 20-year-old Class A building, you're about $20 a foot less. So a company at 100 Summer Street, which is it's a high quality but not new office tower in Boston. The rent there was kind of mid 70s gross. I think on the 30th or 31st floor for a brand new transaction. So that's a $30 delta to this other building. There's other buildings where Morgan Stanley just went through a couple $100 million renovation of a tower. That was an older tower. Their rents will be in the 80s gross versus 100 for the brand new construction. So it's a 20% premium placed on those 20-25% premium placed on those transactions for the newest space. So companies are making the move with a reduction in square footage to be able to afford it, right? And I think the pipeline for new buildings behind what is being delivered now that was started probably pre-COVID or in the COVID, in the middle of COVID is, I think it's down, I've read somewhere around 70 or 80% nationally, right? So there is a massive amount of a reduction in new supply coming to market. And what does that mean? If companies favor new buildings, there's leasing happening in new buildings that's overweight to the overall market. What happens in 2, 3, 4 years as absorption catches up to inventory of these new buildings and there's nothing behind it being delivered? That's the sell of a landlord broker right now. And honestly, I think as you look at some of these markets, I think it's going to be very difficult for tenants to get their heads around what pricing is for the nicest assets in 24 to 36 months, because rents will run as these buildings get deals done.
There's nothing new here. We've talked about this on almost every episode of the podcast. It's this, although now you're saying 40% of Manhattan is occupied, no vacancy. So when you first mentioned the ultra premium product, I think, Brian, you were using 5% or 6% of the market. I was arguing that it's 2% of the market. And isn't it interesting that in this moment, both things can be true? That's sort of a bifurcation of the market where the nicest buildings are seeing positive rent growth and the rest are languishing and some will need to be torn down. Both things can be true. And here we are talking about it again.
Yeah. And funny is that despite this conversation and the amount of headwinds the office market still has, it wouldn't be surprising to me if you start to see some developer start to think about building again. I know that sounds crazy, but that's the way the world of development works, right? You're trying to perceive the demand, and people typically, I find, react emotionally and then justify it with fact. So it's nuts. But right now in New York, there's no new speculative office buildings being built. There's none in Seattle. And I want to stress to listeners here, I won't go out and actually name the buildings because I don't want to call them out per se, but there's buildings in Seattle that are absolutely categorized in the luxury class, okay, class A plus, that are absolutely hemorrhaging. Either they're 100% vacant because they were delivered during the pandemic, new construction, or they just are unable to do deals based on their loan covenants or whatever it might be. They just cannot transact at market rents. And so there are still tremendous amounts of opportunity. Seattle and the West Coast cities like San Francisco, LA are not New York City. Yes, we're seeing some increased amount of demand. There's no question about it. But by all means, there is still tremendous opportunity, at least in the West Coast cities.
Okay, so when we talk about the high end of the market, I toured a project in South San Francisco, the Kilroy Oyster Point project. And, it's so amazing how much the amenity offering becomes the value proposition. I mean, the buildings are nice. They're good bones, but it's the amenity offering that makes one project stand out just a bit more than the other. And so here was the first time I had heard about this. Kilroy has signed an MOU with Archer Aviation. Are you all familiar with Archer Aviation? To be one of 4 or 5 stops around the Bay Area for their eVTOL, the electric vertical takeoff and landing 4-person passenger helicopter. It's basically a drone, and they're going to fly to Livermore in 10 minutes, what would normally be an hour and a half commute. And so there's this new commuting tool that they're promoting as part of their offering package. It's not available yet. It's in the near future. Archer's in dealing with the FAA to get all the approvals, but this is the future. This is coming. It's worth Googling to see the image of these 4-person passenger drones. It's going to be a piloted, and 1 pilot, 4 passengers. And so Kilroy went and got an MOU so that they're one of the stops. There's going to be 4 or 5 stops around the Bay Area. Super interesting.
That's the first time I've heard of that amenity, and I love it. It's, the amenity focused buildings and locations are going to lease faster. People, and it all is driven by the employee. Employees don't want to be on an island. They want to be a part of an ecosystem. They want to be a part of the community. They want to have amenities. They want to have live, work, play. We've been talking about that since it was, driven to the urbanization of these various markets. Like if you remember, John, back when Silicon Valley, San Francisco was not a destination for companies in Silicon Valley until, 15 years ago. There was this whole cycle of tech opening up major outposts in San Fran to bring their people closer to where they lived and the amenities that it offered. And I think now that is kind of going the reverse, where they're trying to find highly amenitized projects that are outside of the urban core. Right. And bringing these type of services where you can then be able to get around. It's amazing. Like if I tell people here in Boston, if I am sitting in my office downtown and I go up to my client's office, which is, I'd say 23 miles away, it's probably an hour and a half to get there, an hour and a half to get back. And then if you're there for a couple hours, right. So it's almost a full day's work just to go someplace. If there was no traffic, would take 30 minutes. And it's 40 minutes max. It's an hour and a half all day long, and it could be 2 hours if it's really bad. So as you look at employees using that same metric for commuting, you want everything right around you. You want your entire ecosystem to be self-contained within the community around you, because otherwise, might as well just stay home because you've built that likely where you live.
Well, and it's easy for Kilroy to embark on that concept, John, because they can do it at scale. I mean, for listeners, like Oyster Point is a 4 million square foot development. Now, all of it has not been built yet. It's on 50 acres. It's 4 miles from the airport, SFO. It's right next to Caltran, just south of the city of San Francisco. So when perceivably, when you have 4 million square feet of occupancy, you can create a campus, and that's what they've done at Oyster Point, or what I should say, that's what they are doing at Oyster Point. They haven't built it all yet. They've only done phase 1, and phase 2 is, I believe, under being leased right now. It's the 3 buildings of 865,000 feet. So, it's going to be hard, I think, for owners of smaller buildings, one-off buildings, to compete with either, like in New York, we're talking about large towers that are over 1 million square feet, that can afford to, build those amenities within the building. Or like Kilroy's doing with Oyster Point in San Francisco, they can do things at scale because they just have the amount of perceived occupancy someday. So, it's going to be like we said, it's going to be a tale of winners and losers. And unfortunately, the losers are going to be those that are, that commodity office building that doesn't have much to offer, and maybe an owner that doesn't want to invest to try and compete. Those are going to be tough, and that's going to drag the market down. But yeah, I mean, if you're thinking about bringing people back to work, John, Oyster Point, I mean, what a cool place to work. I mean, I've seen renderings. I've never been there in person, but it looks pretty amazing.
We talk a lot about in this market the need to earn the commute. I love that expression. I think they certainly do. And the nicest projects and their amenity offerings are there to earn the commute. But what a perfect segue. Let me, and maybe we can wrap on this one, but I wanted to go back to talk about a lonely little single office building that we talked about in Tempe, Arizona, which was being offered for sale as an investment property because they had Amazon in the building on a 5-year lease. It must have been 10 months ago we had this conversation. I think it was you, Brian, that said the building was effectively unsaleable. The idea being, unless you could get Amazon to pre-commit, renew early, that 5 years wasn't enough time, you wouldn't want to get that building back empty in 2029. Anyway, it's been marketed 228 days or something like this, and it's under contract. Oh, by the way, I don't know if we ever mentioned this, but the seller is Strategic Office Properties, but it looks like it's a joint venture with ASU, Arizona State University. It's actually kind of near and on the grounds of Arizona State Research Campus, but it's under contract. Somebody's buying it. And it was originally offered at an 8.75 cap rate. It was, let me give you the number, $247 a square foot, 100% lease, single tenant, Amazon. So at an 8.7, either did they get Amazon to commit to stay longer, or is somebody really willing to gamble and buy that building today? And if so, what do you think the cap rate would be? You thought there wouldn't be a buyer, but somebody local who sees a nice building apparently is stepping up. What's your guess? What's happening?
Well, first of all, to defend myself here, John, the facts as currently on the record at the time, Amazon had not announced that they're bringing all of their people back, right? So a huge difference. I think if you want to get confidence in a building that's master leased by Amazon, I think the day after they announced they're bringing their people back, I think you feel a lot better about that building, and the market would feel a lot better about it. I'm sure there's been significant due diligence on their occupancy and use of the building, and if they're in there using it, you're back to a pretty high likely that they're going to renew. Amazon is historically, and Owen, you probably know this better than anyone, so maybe oversimplifying, but they're a value tenant. They want to try to maximize the value, and in a market where it's hundreds and hundreds of dollars to move, if they're back in occupancy, there's a pretty high likelihood they'd probably stay. So I can confidently change my position on the building not being sellable now that Amazon has made a decision to bring their people back to the office.
John just loves bringing this up every other episode, like clockwork. For the last 20 episodes, we've been getting an update on a random building in the middle of Arizona. Thank goodness for that. I don't know. I mean, Brian, the building hasn't sold yet, right? It's only under contract. There's still opportunities for it to fall apart. So Brian doesn't even need to defend himself yet. And undoubtedly, we will have an update from John at every step along the way. Okay, let's wrap up there. Thanks everyone for listening to episode 47. We'll be back soon.